Okay. Hem.
Yes.
Hi.
Hi.
So Hem is an old colleague of mine and a good friend of mine as well.
Indeed.
So Hem, tell me about yourself a little bit. What you do, a little briefly.
So my background that's relevant for this conversation is that I've been involved in the world of mortgages for basically my entire career. Ever since leaving university, where I studied economics, I then went into being a mortgage broker at one of the largest mortgage brokerages in the country.
Which one was it?
A company called London & Country. London & Country Mortgages.
Okay.
I basically learned the basics of being a mortgage broker there, and I was there for about 3.5 years. And then I moved to London and ended up joining one of the largest mortgage brokerages in London, a company called John Charcoal, where I worked for best part of about 5 years before then moving into the mortgage tech space where we met. And then I did some stuff in the mortgage tech space before moving back into being a broker. And for the past 18 months or so, I've been being a broker again. What that basically means is that over the course of about 10 to 12 years, I've probably arranged upwards of 1,000 mortgages for people all the way from a first-time buyer to people with property portfolios worth several million, 30, 40 properties, CEOs of large businesses, people that earn millions and millions to people that earn less. And so I've got a wide range of experience in dealing with lots of variety of things in terms of the world of mortgages.
Thank you for that. So my first question. Mm-hmm. So as a first-time buyer,
sure.
So what are the common mistakes a first-time buyer can do and how to avoid them?
So I think there's a few mistakes that first-time buyers can make that are primarily around organization. So firstly, it's making sure that all of your documentation is registered at the right address, because the address that the lender is going to want to use is the address where you currently reside. So a lot of first-time buyers, for example, might have their address or their documentation at an old address, especially if you only use online accounts, or they might have it at the parent's address, so they can't evidence their address properly. That's a common mistake.
You mean like the bank accounts and like telephone numbers?
Precisely.
Those type of things.
Precisely. Okay. Another thing is active credit. So as part of the application process for a mortgage, you'll be credit scored. And that credit score is individual to each lender. And part of what forms that credit score is your credit history. So by credit history, we're talking about things like, have you used a credit card or had a loan? Anything like that. Have you kept up all your payments if you've had any credit? Now, the misconception is that no credit is an okay thing. In reality, for the lender, it's an unknown entity. It's an unknown quantity if you've had no credit whatsoever. So one of the things that I encourage first-time buyers to do is take out a small credit card. Don't go nuts. I'm saying, when you go to Asda or Tesco, the money that you're going to spend on your debit card, spend it on the credit card instead. Go home and pay it off in full. These days, there's also companies that will let you register your rent on your credit file as well. And what you're trying to do is establish a credit footprint so that when it comes to credit scoring, you show the lender that you exist, which then increases your chances of being able to pass a credit score as part of this process. That's a big one.
What if you don't? What if you didn't prepare yourself and you're applying for it? And is it too late?
So in some ways it is, in other ways it isn't. So what I mean by that, let me explain what credit scoring actually means.
Okay.
So when it comes to credit scoring, what the lender is doing is effectively taking all the information from your credit reference agencies like Experian or Equifax or TransUnion. They are combining that with the information that you've put onto the application form, and they then generate an internal score. So each lender has their own algorithm that weighs things differently, and it generates an internal score. And just to make up some figures, if you had a 10% deposit, for example, the lender might say that we need to get a score of 750. If you have a 15% deposit, you need to get a score of 725. And 20% deposit, let's say 700. Making up the figures as we go, but you get the general idea.
Yes.
Now, if you've not had a lot of credit, then the likelihood of getting one of those higher credit scores is lower. It doesn't mean it's impossible, but it does make it more difficult. Now, if you don't pass with those lenders, there are other types of lenders that do credit checks instead of credit scoring. When they're credit checking, what they're doing is basically making sure that there's no adverse credit history. So there's no missed payments, there's no defaults or CCJs on your credit file. So as long as you've not had any of those things on your credit file, you can still pass with those lenders. Now, the bad news is that the majority of the high street lenders, pretty much all the high street lenders, credit score rather than credit check. So if you can't pass a credit score, you might end up going to a non-high street lender, which is likely to lead to a higher interest rate. Not always the case, but most of the time that will be the case. So that's the risk that you take by not having your credit score in the right sort of place. And just to kind of cover off credit scores a little bit, the figures that you see on Experian and Equifax, etc., are not the scores that lenders use. So the lenders
is completely different.
Completely different.
Okay.
Exactly. Those scores make us feel good about ourselves, but they don't actually mean anything when it comes to getting a mortgage, unfortunately.
Yeah. How about the ones that we see on our bank applications? Now, the bank applications nowadays are showing your credit score as well, and then explaining why you get that score and everything.
So again, that's an internal thing to that particular bank. It doesn't mean that you're going to pass with another bank.
It's also nothing to do with the
Correct.
mortgage or any kind of credit scoring. It's just bank to bank, basically.
Precisely.
Yeah. You found an apartment,
Sure,
or a house, and you want to get a mortgage. What is the first thing that you do?
So prior to actually looking for an apartment or a house, ideally, what you've done is you've spoken to somebody, whether that's your bank, whether that's a bank, or whether that's a broker like myself, and you've actually checked that you're eligible to get a mortgage.
Which is pre-approval,
That's pre-approval. Now, there's different ways to get pre-approved. The first way, the most common way that people are familiar with, is called an agreement in principle, sometimes called a decision in principle.
Yeah.
Now, that isn't worth the paper it's written on. It's nonsense, basically.
Okay.
Essentially, what's happening in that process is you're checking whether or not you passed a lender's affordability assessment and whether or not you passed their initial credit score. Often what they call a soft footprint credit search. What a soft footprint credit search basically means it's only available. The only people that can see that a credit search has been done are people within that bank's particular banking group. So if, for example, I did it with Santander, only people within Santander could see that they'd done a credit search. Somebody at Lloyd's couldn't see that, for example. Does that make sense?
Yes.
Cool.
So as far as in my knowledge, I've seen that there's two types of credit checks exist. One is like soft check, which everyone, I think, can see it, or it was other way around?
It's the other way around. So soft footprint is the one that only internally within the bank you can see, or the banking group, I should say.
Yeah.
Externally, nobody can see that it's been done. A hard footprint, everybody can see. Now, if you still do multiple soft footprint credit search, that can still have an impact on your credit file. So you don't want to go and do 5 or 6 of them in a short space of time, because that's going to start affecting your credit score, even if you pass all of them. Okay. So you want to be a bit sensible about what you do there. Now, a lot of estate agents ask for an agreement in principle because they want to make sure somebody's a serious buyer.
Yeah.
However, you've not really proved anything as part of that process, because you've not evidenced any of your income. You've just said, I earn this much. I could say I earn £500,000 today. I have no way to evidence that, but nobody's asked me to evidence it.
What if someone just wanted to see and they earn 500K a year?
Sure.
Would that affect in their credit score or their credibility later on date, or this is just like a soft?
It's just an initial check. And what the lender's doing is they're doing an affordability assessment.
Yeah.
So that they're saying, does somebody that earns £500,000 a year with these debts, could they afford to borrow this loan size? And if the answer is yes, they'll say yes, because you've not had to evidence anything at that point in time. Yeah. Obviously, it's in your favor to actually give the truth, because you want to get a decent outcome and a realistic outcome. Yeah. But there's nothing obliging the lender to lend to you at that point in time. That's simply an idea of what you're able to do. Yeah. Now, if you've had no credit issues, you don't really need to do a credit search to actually check your affordability. Every lender has an affordability calculator, so you can work out how much you can afford to borrow without that. So most of the time where I'll do a credit search is where somebody's either had adverse credit, so they've had some missed payments, they've had some defaults or CCJs in the past, or they've not got very much credit history, and we're not sure if they're going to be able to pass a credit score. Or if, it's basically those two scenarios, or where we're kind of not 100% sure whether somebody's going to be okay to do it or not. Otherwise, if you come to me and say, I've had credit and it's generally been pretty good, I've kept up all my payments, I'm not concerned about you passing a credit score. It's more about, let's understand how much you're likely to be able to afford. The other thing to bear in mind there is, if I go and get an agreement in principle with Santander today, who's to say Santander have got the best rate by the time that I'm actually ready to proceed with a mortgage? It could be that Nationwide have the best rate, or Halifax, or anybody else. So I don't want to start credit scoring myself unnecessarily unless I really, really have to.
Yeah. So, and that's the point that you actually found your apartment or your house that you wanted to buy.
Precisely.
Okay.
Precisely. And just to kind of come to that point about what happens once you do find a house that you want to buy. So as part of the buying process, the agent will often ask you whether you have an agreement in principle. So you can confirm that, yes, I've spoken to a mortgage broker, I've spoken to my lender, and they've confirmed that I'm good for the money. And most brokers will have some way of confirming that they've checked that you're okay for the money. Once an offer is accepted, that's when the real work of buying a property really begins. So once an offer is accepted on a property, that's when you collect all the information, and that's when you start researching the market to identify who's going to be the best the mortgage option for your particular needs. When you talk to someone like myself, you'll also get advice about what's the best type of mortgage to go for your particular needs. So there could be a fixed rate or a variable rate. How long do you want to borrow the money for? All these things depend on your personal circumstances. So that's what we have a conversation about. That's when I then start looking at lenders and identifying who's going to be okay with lending to you on your particular circumstances. If you're what we call a vanilla case, where pretty much everyone can lend to you, you're just looking for the best rate.
Yeah.
But if you've got something a little bit quirky about your circumstances, or sometimes it's not even you, sometimes it's the property that you're buying. So, you mentioned a flat. If you're buying a flat that's, for example, above a commercial premises, not every lender is going to be able to lend on that property. So you have to try and identify who's going to be the best option. And then I can come back with a recommendation and say, Naeem, this is the one I'm recommending to you. Here are the reasons why, and these are the details of the products I'm recommending. And then you can say, great, yes, happy with that, let's proceed. Or actually, why didn't we look at this, or this?
So it is important, if you're decided to get a mortgage, you need to speak to a financial advisor. Yourself.
From a personal interest perspective, yes, yeah. I would say speak to somebody, just in the same way where... Yeah. If you're fixing,
it's always a good idea, though.
Yeah, I mean, some people are good at fixing their car on their own.
Yes.
A lot of people aren't good at fixing their car on their own.
But you need a lot of research, right? Like you already have that research, you already have that knowledge. So
precisely, I've been doing this every day for 10 years. You do it once every couple of years in best case scenario. So yeah. I'm likely to know just more about the market just through exposure alone.
Yes.
Can you tell I've had this conversation over and over and over again?
I can actually, yes, I do. I really can. Because you're just like, that's straight to the point.
Yeah.
Okay. So you are looking for the best deal and you've checked out the rates, and the rates that you're looking at, it's not what you're expecting, and you want to get the best deal, and you want to negotiate on the deals.
Sure.
So how do you do that?
The short answer is that you can't really negotiate on deals.
Okay.
The deal is the deal. The deal is what's available on the market at that point in time.
Yeah.
What you also have to understand is that the best deals on the market, they depend on how much you're trying to borrow, over what time frame you're trying to borrow the money as well.
Yeah.
But in addition, it all depends on your circumstances as well. So if you have a particularly niche, difficult circumstance that's hard for lenders to lend against, then they can't lend to you. So the analogy that I give for this is, imagine that if you had a very straightforward case, there were 10 lenders on the market, each one of those lenders could lend to you, you're going to get the very best rate on the market because every one of those lenders can lend to you.
Yeah.
Now imagine actually there's something in your particular circumstances that makes it much more difficult. Let's say, for example, you're self-employed and you've only been self-employed for a year. Now, of those 10 lenders, only 3 lenders can lend to you. Now, if the cheapest lender was one of those 3 lenders, it wouldn't have made a difference either way. You would have got the best rate possible.
Yes.
However, if those 3 lenders have got the worst 3 rates, you've had to forgo the first 7 lenders to get the 8th best rate because of your circumstances. So, unfortunately, for the vast majority of us, there's no way to negotiate a mortgage. What we can do is we can try to arrange the best mortgage for ourselves in terms of what's going to meet our financial future. What do we expect to happen in our personal circumstances? An easy example is if you have kids and you're thinking that the area that we're in is great for primary schools, but it's terrible for secondary schools. What you don't want to do is tie yourself into a mortgage that's going to take your kids beyond the age of beyond the age of primary school, because at that point you're going to have to pay a penalty to get out of that deal in order to move home to another property where the secondary schools are going to be better for your kids. Does that make sense?
Yes, it does. It really does. Yeah.
Does that answer the question?
It actually does. So the answer is you get the best possible deal out there. You don't negotiate your way into it.
Unless you're borrowing millions, yes. The short answer is yes.
What happens if you borrow millions? Like if you, let's say you have millions of pounds and you can afford any building, but you just don't want to pay the full price. You just want to get a mortgage.
So you can go to a private bank and you can negotiate a rate with a private bank, but they're going to expect you to put lots of money on account with them.
Yeah.
And you're probably still not getting the best rate on the market. You're getting the best rate for your particular circumstances.
Okay. All right. Fair enough. So even if you have millions of pounds, you still get the deal what you get.
Pretty much.
Okay.
The banks have billions, you have millions, you know?
Yeah, that is true. That is true. Well, I guess if you have billions, you don't need to take a mortgage.
Exactly.
Right. We are getting our mortgage. We applied, talked through an advisor, and they helped us to apply, and we passed all the checks and everything. What are other reasons that our application can be denied or the deal can be cancelled?
Sure. So there are a variety of reasons why an application might fall down. So firstly, the first hurdle is credit scoring. So if you don't pass the credit score, the lender won't lend to you.
Yeah.
So that's the first one. But let's assume that you do pass the credit score. The next one could be that you are unable to evidence the information that you provided. So this is something that your advisor should be checking up front, but let's assume they haven't done that for now. If you told me that you earn $50,000 a year, but actually you earn less than that and your pay slips demonstrate less than that, then that could affect how much you're able to borrow. Similarly, if you have more debts than you've declared, or you've got some old debts that haven't been updated on your credit file, that could also affect how much you're able to borrow as well.
How about you have this income, but it's not stable? Like you have one stable income and on the side, you have this side hustle,
Sure.
let's say, and it's not exactly the same each month, but you declared it as your annual income from the last year, but this year is not, it might not be the same. It might be more, it might be less.
Sure.
Would that be a reason for mortgages to be failed?
So it depends really on what the lender's criteria is and what the side hustle is. Now, most side hustles are on a self-employed basis. So
Yes.
if you're self-employed, lenders generally want at least 2 years worth of figures before they'll take it into account, and they tend to average those 2 years figures as well. So that tends to provide them with some comfort. However, if your income is too erratic, or there's not a good enough story behind this, the lender might turn around and say no. And that kind of highlights a broader point as well, which is not giving the lender the full story. So you want to be as upfront and truthful as possible with your lender, or with your broker at least, when you're arranging a mortgage, because it's going to come out. And when it does come out, if it's not been revealed up front, the question that always lingers in the underwriter's mind, the underwriter is the person that's assessing your application at the lender, that is, well, I found this. What other things haven't I found in the background that this person isn't telling me about?
So it's basically all your financial information is under the microscope.
Your financial, but also your personal life. So
Okay.
what I mean by your personal life is what's happened in your history that could have an impact on your ability to repay this mortgage.
Like what, for example?
It can be things like if somebody's had, we've talked about adverse credit before, where somebody's got missed payments or defaults or CCJs. Now, a lender...
But isn't it more of a financial identity than the personal life?
Well, it can link to your personal life, because if a lender finds out about this and it hasn't been declared for whatever reason, or there's something on your bank statement. Another easy example is there's things on your bank statements that you haven't told the lender about, but actually indicate that there's more outgoings or there's more debts. One that lenders actually really hate is gambling. They don't like to see gambling on bank statements.
Okay.
That's one lenders don't like to see.
Yeah.
But generally, it's the situation where the lender thinks that you're not providing as full a story as possible about why something occurred, or they think that there's a likelihood or a danger that this could be happening. But actually, that's not even the most common reason why applications fail. So to understand how mortgage applications work, basically what the lender is looking to do is do two things. They're looking to approve you as a candidate, and then they're looking to approve the property and say, so A, is Naeem a good candidate for a mortgage? Can we lend to Naeem? If the answer is yes, great. What they're then looking at is, can we lend on the house that Naeem wants to buy? And if that answer is yes, you got 2 ticks, then you get a mortgage offer. However, if they turn around and say, well, we could lend to Naeem, he's a good candidate, we like him, but actually the house that he's looking to buy, we can't lend against for X, Y, and Z reason, then the application fails. And actually, so with any purchase, especially in England or Wales, what can happen at any point throughout the transaction period is that the chain can fall apart. So firstly, are you familiar with the property chain? Do you know what that is, or do you want to explain?
I'm actually not.
Cool. So we have a weird way of buying and selling houses in England and Wales. A lot of friends from abroad think it's very strange, but essentially what happens is, if I'm selling my house, you decide that you want to buy my house. Great. But you own your house already, so you want to sell your house in order to be able to buy my house. So we sell it to a third party. Let's say we've got a friend called Andy. Andy buys your house from you, and Andy's got to sell his house. He's going to sell it to somebody else. That person happens to be a first-time buyer, so they don't need to sell anything. Now, we need all of those transactions to all take place pretty much simultaneously in order for all of our purchases to go through. If Andy pulls out for whatever reason, let's say Andy can't get a mortgage. Suddenly our chain falls apart because you can't sell your house in order to buy my house.
What's the point of doing something like that?
Completely irrational. But no, the short answer is that people in the UK like owning houses.
Yes.
And we don't like the idea of temporarily moving into rented accommodation in between buying houses. In other countries, that's not such a big deal. In the UK, we construct these chains, and these chains can go not dozens, but 10, 15, 20 transactions all simultaneously. And if one of those falls apart, the entire chain can fall apart.
When the chain falls apart, the deal doesn't go through, right? That's the only issue.
Correct.
And you need to wait until everybody, chain is completed.
Precisely. Because somewhere along the line, somebody can't afford to pay that person the money that they need to pay. And so until you can find a way to fill that hole, that gap in the chain, the chain's stuck, essentially.
Okay, that's very interesting.
And that's pretty much the most common reason why. So somewhere along the line, somebody can't get a mortgage, or the lender won't lend on a particular house, and that's what kills the chain.
Okay, you mentioned something about so mortgages can fail for 2 reasons. Mm-hmm. One, if your credit score or your financial checks didn't go through.
Sure.
And the second one, if the checks on the apartment or the property that you're trying to buy didn't go through. Sure. What are those reasons? What are the most common ones? So
there's lots of different reasons why that can kind of happen. It does depend on the property. With every flat in the country, every apartment in the country, the lender will always say it's down to valuer's comments. That's basically just a nice way of saying we're not going to say definitively that we'll lend on this property until somebody's actually been around to have a look at the property and made a call as to whether or not it's acceptable. There can be various reasons to construction of the property. If there's damp or any sort of structural issue with the property, that can affect a lender's ability to lend against the property. So they may turn around and say no. Essentially, what the lender is always going to be concerned about is one fundamental thing. It always comes down to one fundamental question. If this person can't pay their mortgage, we have to take possession of this property and we have to sell it. How easy is it going to be for us to sell?
I see.
And if you're buying a flat above a restaurant that's got lots of noise, lots of smells, lots of food, all that sort of stuff, that's difficult. Even if it's a really nice smelling bakery, not everyone wants to live above a bakery. It also explains why flats are harder to lend against than houses, because everyone's fine living in a house. Not everybody is okay living in a flat. So the market of people that you can sell to is reduced. Not completely, but it's a little bit more reduced. So that's why lenders will have stricter criteria for flats than they would for houses.
I see. In that sense, getting a mortgage is a good idea because basically lender is checking this type of stuff, right? So
Correct.
you're making sure that you're going to get the best possible deal.
Correct.
If there is something wrong with the property that you're trying to buy or someone just trying to scam you, then it will come up.
100%. Well, not always. Not always. I
Okay.
will say that because there are different types of different depths to which the lender can go
Yeah.
in terms of the survey that they do on the property. So they can do a really basic survey just to make sure it's mortgage okay from a mortgage perspective.
Yeah.
Or they can go into more depth. That's called a homebuyer survey or a structural survey. And they go into more depth and they work more on your behalf than the lender's behalf. So even if you're buying a property for cash, getting a survey done is a sensible idea.
Okay.
It just reduces the number of surprises that are likely to come up. And when you're buying a new built property, getting a snagging report is also a very good idea.
My last question on this topic: which type of lenders are actually doing this extensive research? Is it like a banks or private lenders, or
Can you rephrase the question? I'm not quite sure I understand.
what type of lenders are actually going into details? Like, just they don't do soft checks on the property.
I see. So every lender. Every lender does a survey of a property.
Yes.
Now, how they do a survey of the property is dependent upon a few different factors. It depends on who the lender is.
Yeah.
It depends on the what's called loan to value. Loan to value is a really simple concept. It's what proportion of the property value am I borrowing? So
Yes.
if I have a 10% deposit, my loan to value is 90%. If I have a 15% deposit, my loan to value is 85%. Really straightforward. Now, every lender will want to do a survey of the property, but they'll only do a basic survey for mortgage purposes. They won't go more comprehensive than that. That's basically just making sure the property is standing upright and it's not going to be terrible to try and sell on or anything along those lines.
Yeah.
If you want more in-depth stuff, that's where you go for the more comprehensive survey. But sometimes if you've got a really large deposit, like if you've got a 40 or 50% deposit, some lenders will just do an online survey instead of going to do a physical inspection of a property.
Oh, I see. Okay.
Because they trust that the amount of deposit you're putting down is going to override any real issues around them being able to sell the property on and get their money back.
In that case, we can say if you want to get a proper, decent check or decent survey on your apartment or the property that you're trying to buy, you need to go for you need to outsource that. Like you need to go for a private company to do that for you.
Yes. So I would say a couple of things there. So the first I would say is the lender's going to do that for you to a certain degree. And it depends on the type of property that you're buying and how familiar you are with that property and whether you think there's going to be any issues or anything along those lines. But secondly, if you are going to outsource that to a third party and get them to do a survey for you, wait until the lender has done their survey first, because you're going to have to pay for their survey regardless. And then if their survey shows something, it means you don't have to pay twice. But secondly, once they've done theirs, if you then go and do your survey, you've got access to more information about what you want to do with that survey. You can pay the lender to do a more comprehensive survey if you wanted to, or you can pay a third party to do it privately yourselves. Typically, I recommend doing it yourselves after you've had a mortgage offer from the lender.
Now we can talk about that controversial topic, rising interest rates.
Sure.
Yes. So what type of impact do you think that is going to have on housing market?
So I have my own personal theory, and it is a theory.
That's what I'm asking. Actually.
I could be completely wrong.
It's not a financial advice.
None of this is financial advice.
None of this is financial advice. This is just two friends discussing.
You can call me for financial advice, but this is not financial advice. No, so my personal theory is that in the next 12 to 18 months, we are likely to see an increase in rents, and we are likely to see a drop in house prices.
We already started to see increase in rents and dropping on the
and it will only get more exaggerated.
Okay.
And the reason I'm saying that is I think the number of people that have got a buy-to-let property, so a property that you've purchased to rent out to a third party, is the number of those people that are coming out of their current deal that's at a relatively low interest rate, let's say 2 or 3%, and they're going to find their interest rates north of 5%. And that just affects the entire economics of their business model and may make that business model not feasible anymore or significantly less attractive. They may choose to cash in on their property, sell their property, take the capital gain and go and do something else with their money because it's easier than being a landlord. What that does is it reduces the supply of rental properties in the market, so that forces rents up, but it increases the supply of properties on the market to be sold. So that reduces the pressure on prices. So we might see some decreases in prices as a result of that. Obviously, this varies area to area. So depending on where you're based, you may see prices generally increasing, but in other areas it may drop off much more significantly. That's my pet theory as to kind of what's going to happen in the next 12 to 18 months. But we'll have to see kind of how that comes about. As for generally how things are how interest rate rises are affecting the mortgage market in general, the way that lenders react is they tend to overreact to any given external factor. So in this case, they overreacted to Liz Truss kind of trying to blow up the economy. And as a result, interest rates kind of went sky high, and then now they're returning to mean. The reality is I don't think we'll see record low interest rates anytime soon.
Yeah.
I think we're more likely to come to what sort of historical norms. And people have to get used to paying it again.
What are those historical norms? What's the range that you
in the UK? I think
4 or
it's
5%.
Ballpark 4 or 5% is kind of generally where people think about. It depends on how much deposit you put down.
Yes.
So one thing to mention is the more deposit you put down, the lower the interest rate is going to be from a lending perspective. But that the range of how much it can drop has also reduced as a result of kind of rising interest rates as well. But the Bank of England base rate doesn't directly affect the mortgage market because the lenders that borrow in order to fund their lending, they borrow on the money markets. They borrow, and so swap rates are actually what causes more fluctuations in the mortgage market than the Bank of England base rate. What you'll also see is that lenders will increase their interest rates when they want to reduce the flow of business into the flow of volume of business. So they will always constantly play around with that so that they can manage their service levels. What that basically means is when I send an application to you, how quickly can you deal with that? How long is it going to take you to deal with that, essentially? So they want to manage that timescale so that it doesn't get dragged out too long. So they will increase their interest rates to manage that and take in less business when they're very, very busy.
We were talking about interest rates.
Mm-hmm.
Obviously, before the interest rates hike,
Sure.
there was a global pandemic
Yes.
that was happening in the world.
Yes.
And that affected the housing market as well as everything else in the world.
Sure.
And what were those effects? Like, in your professional opinion, what type of effects that you saw in mortgage deals? Because I remember during the pandemics, rents were super low.
Mm-hmm.
And I think interest rates were also low.
Sure.
But the prices were skyrocketing.
Sure.
So if you can combine, all of these, like the COVID pandemic and then this recent global financial situation in the world.
Sure. So
what would you say about that? Yeah.
I think the effects of COVID have, in one way, they've diminished. In another way, they're kind of the issue that we're dealing with today. So what I mean by that is, firstly, what we saw during COVID was obviously people weren't able to move around, so people weren't moving into new homes, they weren't buying, the velocity of transactions just dropped off a cliff.
Yeah.
Pretty much what we expected. Post-COVID, it's picked up again, and we're kind of back to normal sort of levels of transactions and people moving around and what we'd expect to see. However, the ways in which we dealt with COVID in terms of basically printing a lot of money in order to throw into the economy to keep the economy going has been part of the cause for the levels of inflation that we're seeing. Not the only cause, but there's
one of the causes.
It's a contributing factor.
It's a decreased velocity, basically.
Exactly. So as a result of that inflation, that's what's causing rising interest rates.
Yeah.
So you could say COVID was a significant part of that sort of process. Without COVID, would we have this? Who knows? But in short, I think the effects of COVID in that way have kind of disappeared. The other thing that has changed a little bit as well is remote working. Although a lot of people are trying to get back to office working and what have you, but the level of remote working increased. So as a result, we've had people move away from central hubs and move further afield so they can get more space or what have you. So that what that has done in local areas is it's really boosted house prices and pushed up house prices in certain areas where they are more attractive for whatever reason, and people have moved out to those areas.
Yeah.
Again, that's died out a little bit, but in certain areas that's been a real thing as well.
Yeah. Most of the companies now actually requiring people to be in the office at least 1 or
Yes.
2 days a week.
Yeah.
But working remote is fantastic. I really like it.
Personally. I agree. I was working remote before it was cool.
Yes. What is the relation between the stock market and the housing market? Or is there any relation? Or would they affect each other in any sense?
I've never personally gone and done the research. I imagine that they are positively correlated for the simple reason of wealth effects.
Yeah.
And whilst trickle-down economics is relatively nonsensical, there is an element of a wealth effect. Maybe it trickle down in the sense of if somebody's feeling wealthier because they've made money in the stock market, they may buy a more expensive property. As a result, they sell their existing property, somebody buys that, and that kind of goes, that chain effect kind of trickles down into the lower rungs of the economy. So I imagine where the stock market is rising, in a generally positive economic environment, the housing market is also kind of moving in line with that.
Yeah.
That being said, sometimes the stock market does decouple from what the economic outlook is in general and doesn't really reflect that. I think we're in one of those situations right now where the stock market is kind of moving in a direction that the general economy doesn't feel like it's moving in, and that can happen, but at a certain point it will kind of come back to normal.
Yeah. Okay, so what I had in when I was preparing this question in my mind is there are some stocks, these are called REITs. So basically you can just purchase a part of housing company,
Sure.
or lenders or hotels,
Sure.
any company that deals with property.
Mm-hmm.
And you can buy shares of these properties. So let's say there is a downturn in the stock market and
Sure.
everybody is selling their stocks and
Sure.
The prices are decreasing.
Mm-hmm.
The effects of this in the housing market, what would it be?
So I don't think that they'll have a huge impact because for the simple reason that the housing market doesn't move at that same velocity as the stock market. Stock market moves a lot faster. If you've ever tried to buy a house, you know exactly how quickly the housing market moves. So I wouldn't say it's one of those where it has an instant impact. I think over cycles, you may see an impact there if actually certain entities are starting to offload a significant proportion of their portfolio or what have you. What we do see is property groups kind of popping up that are trying to invest and crowdfund effectively, or have a property investment group that all buy properties for cash together and they'll rent the properties out and that sort of thing.
Yeah,
we're starting to see a few more of those. How many can actually survive is a different question. I'm curious to see if any will actually survive, because in the past they haven't done very, very well. They come up with a good idea and then the idea kind of fades away as people find it's less liquid than they'd like it to be.
how fast would the property market change compared to the stock market? You said they have different velocities.
Sure. So the stock market changes, microsecond to microsecond in reality. In grander ways, maybe minutes or hours.
Yeah.
Where with the housing market, we're talking in general more weeks and months. For the simple reason that there's always going to be transactions being fed through the process, and they're going to continue no matter what. And generally, a typical house transaction today would take somewhere in the region of about 6 to 8 weeks, maybe a little bit longer, but in that sort of ballpark if everybody's ready.
Even though you're getting a mortgage.
Even though you get a mortgage, correct. Okay. If you're buying with cash, you tend to move a bit faster.
Yeah.
That's the benefit of buying with cash from both sides. But yeah, in general, the housing market is working to weeks and months, whereas the stock market is working to seconds, microseconds, even minutes and hours at worst.
Depending on the company, I guess.
Depends
If
on the company.
company is volatile, then
exactly.
you will get a change instantly. Politics and regulations.
Sure.
How do they affect the housing market and mortgages?
So they can affect it in little ways and big ways. So some of the big impacts that we've had, it tends to be from regulators like the FCA, or that's the Financial Conduct Authority, or the PRA, the Prudential Regulatory Authority, I think PRA stands for. I have to double check that one. But essentially, they can implement things like affordability checks. So they can insist and they can hold the lender to account and make sure the lender does certain things by making them responsible for those things. And if they don't do those things appropriately, they can be fined and they can be punished accordingly. So lenders are very, very hot on those things, and they will want to make sure that they're implemented. Now, in the residential market, what that generally means is things like affordability is a very, very clear example of where the regulator has stepped in and said, you need to ensure that your customers can afford this, and you need to have a clear model of how you're assessing this. So you have to be able to demonstrate to the regulator how you're assessing this. So every lender has to have that publicly available. That's a great thing.
That's public information, so you can check it out by yourself as well.
So you can do an affordability check yourself. You can't see the mechanics of what they're doing in the background yourself, but you can do the check yourself. So you can see how much every lender is able to lend to you.
And those are the websites. Like when you go to a website of a bank, there's this calculators. Is that what it is?
Precisely. Yeah. So it's how much can you borrow is basically how they all phrase it.
Yeah.
So that's their affordability check. In addition to that, you have government regulation that regulates how properties are sold, how surveys are done to make sure the property is going to be habitable, all those sorts of things. In the buy-to-let space, you have government regulation around, or you have regulation around how a landlord can treat their tenants, and things like the deposit scheme, safe deposit scheme, all those sorts of things are all things that have an impact. One that had a quite significant impact, and I think will continue to have an impact, is in the buy-to-let space. The lenders have to stress test the rental income to make sure that the landlord can afford the mortgage in the event of interest rates rising. That leads to landlords being able to borrow less money. So the landlords have to contribute more to the deposit in order to be able to buy the same property. Does that make sense?
Yes, it does.
So that's like I said earlier, that's one of the primary reasons why I think a lot of landlords will sell, because they won't be able to put down as much money.
Thanks for the valuable information, Hem.
Absolutely. I'm glad to be of some use.